Ind AS 104 insurance contract. The objective of the standard is to specify the financial reporting for the insurance contract for an entity that issues such contracts for insurer. Usually, this Ind AS is only for insurers, not others. In particular to this Ind AS require the limited improvement to accounting for by insurers for insurance contracts. Okay, want to account the insurance. Okay. Disclose the identifier is disclose that identifies and explains the amount of an insurer's financial statement arising from insurance contract and help user of this financial statements understand the amount, timing, and uncertainty of future cash flows or insurance contract. Insurance business is they will say if for this risk, if you pay this premium, we will assure this amount. The revenue for this insurance company is want to see this revenue. That is a totally very good project. How if I want right now, it will be very good. What they do, they get their loan. They provide insurance. They get the money. They will ascertain this is the statistics. This much may the expense fee will be there. So they can do two things. One, if that risk what they assure they will repay, that for the client the obligation has arisen for the client if that insurance need to be paid, but if they not paid, it's a profit for them first. Second thing is the total insurance amount they claimed, if none of them is being paid, none of them of the insurance amounts what they collected is paid to the insurer, then the amount is profit, totally profit. If they need to pay, it's a loss for them. What they can do with the money, that's their problem. But the income which arises of the contract, it's one thing. Second thing is there will be a risk and rewards insurance, 1 year insurance. They have for 1 million insurance has been issued. For each insurance, 1 lakh rupees is cost. They got 1 million of 1 lakh times. They have that much amount of money, but there is no insurance claim. It's completely reward. But if it is being a 5 years term insurance, then the risk has been continued for next to 5 years. They should have an contingency. They should have a provision for expenses. That is the thing. Definition: the insurance contract. It's a contract under which one party, the insurer, accepts the significant insurance risk from another party, policyholder, by agreeing to do compensate the policyholder if specified uncertain future events and insured events adversely affect the policyholder. They are saying if this accident happened and it is within the conditions of the agreement, if it is satisfy the contractual agreement, then we will pay this much amount as our policy insurance. This amount, if this happen, we will pay you this much. That is the insurance contract. Very good. What's the insurance policy? It is a risk other than financial risk transfer from the holder of a contract to insurer. What happens is sometimes reinsurance as a concept. One insurance company had made the insurance, but they think they don't need to have this insurance in their hand. They don't want any risk in their hand. So what they can do on that insurance amount, what they are willing to make, they will make a reinsurance. That is an insurance risk arising out of it. Or mm, problem is they expected 50 claims will be the current year, but actually that they increase from 50 to 500. So there is a risk they need to pay more out of their pocket. That is a insurance risk. Insured event. It is an uncertain future event that is covered by the insurance contract and creates an insurance risk. So the insurance agreement states so this is the event it may happen. If it happens, you need to what? You need to pay the amount. So this case, what they saying is risk is if the risk is arised, you need to pay. So the risk, that is the event. Example, car accident, you need paid. The car accident is the event. Death, that is the event. If they are insure the death of the person, that is the insurance. Health, health deteriorates, they need to pay the medical bills. The health deterioration is the event. Insurer is a party that has obligation under the insurance contract to compensate the um, policy holder if the insured events occur. Insurer, who is insurer? Life Insurance Corporation India, Bajaj Insurance, Access Health, ICIC Insurance. These are all the companies who are under the insurance companies insurer. Policyholders. It is a party that has a right to compensate under the insurance contract if the insured events occur. So the who gets the insurance, who pays the premium, who behalf the insurance premium is paid, they are known as policyholders. The standard applies to all the insurance contract, including reinsurance contract that entity issues. This insurance section in DAS 104, Ind AS 104 insurance contract applies even to reinsurance contract. Reinsurance contract that the entity holds. The financial instrument that the entity issue with the discretionary participation feature in DS 107 financial instrument disclose require disclose about the financial instrument, including financial instrument that contains such features. The standard exempts an insurance from one requirement other than the NDAs. However, the standard prohibits a provision for possible claims under the contract that are not existent at the end of the reporting period, such as an catastrophe or equalization provision. So they want to make the provision only for the contractual agreement they made, not more than that. That is the thing. Requires a test from adequate of recognized reinsurance. Required test for adequate recognized insurance liability and impairment test for reinsurance asset. Right now, they need to test for two things. One, who have what is the statistics is given for the insurance, that is out of the 1 lakh policy holders there will be 10,000 events, and this amount will be paid. We made a calculation, that is a provision. Is this right? Second thing, we had our insurance risk is being transferred to reinsurance, and that is made a reinsurance asset. Whether the reinsurance asset who, that is a reinsurance we paid, that person is liquid, that person is solvent. So if this problem arises, will he able to pay our dues? That we should see. Requires an insurance to keep insurance liability in his statements of financial position until they have discharged or cancelled or expires or not to offset. Insurance liability against related reinsurance asset and income and expense from the reinsurance contract against the income and expense from the related insurance contract. So they are asking you to keep your liability in the books until it has been, the risk has been moved off. The period of the contract is moved or not. That is the thing. We should wait up until the expiry, until the discharge of duty, until the cancellation of the contract. This liability should be kept in the books, and until after that only it can be reckoned as a income. A standard will also not be applied to product warranties. Product warranty issued directly by the manufacturer, dealers, and retailers. So this this standard will not apply to who? This insurance contract does not apply to product warranties issued by manufacturer, dealer, retailer. 2 years warranty, 3 years warranty, the product we give, that is not an insurance. Those NDAs 104 insurance contract doesn't apply to them. The employee's assets and liability and the employee's benefit plans or retirement benefit obligation reported by defined benefit retirement plans. So some companies may have their own PF fund. So that PF fund, this NDAs 104 insurance contract doesn't apply. The contractual rights and contractual obligation that the contingent on the future to use or right to use a non-action financial item. So that for contractual rights. So I can use the software for this money. That is the insurance. Assurance can't be insurance. So in DS4 is totally different. The financial guarantee contract, unless the issuer entity has a previously ascertained explicitly that the regarding such contracts of insurance contract has been used accounting applicable to insurance contract. In this case, the insurance entity select to apply either Ind AS 32 or Ind AS 107 or Ind AS 109. Then standard as such contracts, and many of the selection contract by the election contract by election of such contract is irrevocable. The Ind 4 can't be used as a guarantee for the issuance of insurance contract. Accounting policy. Okay, this is important point. Okay, contingent consideration payable and receivable in the business combination. Yeah. Mm, Receivable and payable business combination. This is the amount we have received on the books of account during the business amalgamation combination. So you need to that where there this insurance contract can't be applied. A direct insurance contract that the entity holds on a policy holder other than reinsurance contract that the entity holds. Even this, the standard will not be applied to direct insurance contracts that the entity hold on policy holders other than reinsurance contract. Reinsurance contract they can apply, but direct insurance contract they can apply this portion. Oh my god. The Ind AS permits that the insurer to change its accounting policy for insurance contract only if the change makes the financial statement more relevant or less reliable. Or more reliable or less relevant. The particular and insurer may continue any of the following practices, although it may continue using financial policies that involve them. Measure the finance insurance liability on an undiscounted basis. Always insurance liability should be actual, not a discount basis. Measuring the contractual right to the future investment management fees and the amount that exceeds the fair value as implied by the comparison with the current fees charged by other market participants for similar service. So always measure the contractual right somewhat higher than the actual fair value. Okay, using a non-uniform accounting policy for insurance contract of for subsidiaries. Although they continue to use the accounting policy, it must may continue to following practice. Hmm. NDAs permits insurance to change the accounting policy. So, in the remeasure designated insurance liability to reflect the current market interest rates and recognize a change in the liability in profit and loss account. So, we need to change accounting policy, but before that, we need to see whether the current market interest rate is properly there and liabilities are being properly dealt in profit and loss account. Without this permission, the insurer would have been required to apply the changes in the accounting policy consistently to all similar liability. So, without doing so, they can't do anything. It's very important to accounting policies before changing it. They need to remeasure this interest rate and the liability to be charged in penal. The NDAs requires disclosure to help users understand amount of the insurance financial statement that arise from insurance contract. So why this NDAs is there? First thing, the user of this financial statement of who insurance company to understand what is the amount that is outstanding, what is the amount that is earned by the insurance company. First, right? And the nature and extent of risk arising from the insurance contract. And the second thing is what is the type of insurance they are going on and what kind of risk they are carrying on to continue the business that they should see. So this is the two main thing that the insurance company is looking for in the financial statements from this Ind AS 104 insurance contracts. Insurance contracts.